Hello traders, so today we are going to review a strategy called simple moving average strategy, which is, I'm sure, the basic tool that many, if not all, traders use in everyday trading to serve as an indicator whether the price is bullish, bearish, going sideways, simply because it's extremely reliable when it comes to in terms of an indicator, and it's very easy to put into your chart. So if you're using TradingView for charting like I am, you just go to indicators, and then here in search bar you write moving average, and here you can see we are talking about this one, the start one, simply because this is the simplest moving average. You have other ones like the exponential one, which are more complicated to use, but now we are just going to talk about a simple moving average and how to incorporate this indicator into your trading. So what you need to know about the moving average in the first place is that it's based on the close of the certain number of previous candlesticks. So here, if we have 100 moving average on a 1 hour chart, it means that this price that it's here, for example, is the average price of the last 100 closing prices at the 1 hour chart. More or less, when we use the moving average to help cut down the amount of noise and to make sure that our charts are more clearer and we have a clearer picture of what is actually going on. So the price usually, this blue line, which is 100 moving average, is usually either a support or a resistance. On some very choppy charts you will see that the line is going through the candlesticks, and when that happens, like for example you have also here in this euro dollar chart, you can see that we go constantly through the candlesticks and we go up, down, up, down, up, down, which is usually a sign of a choppy price action. In this particular case that I want to show you, so here we went above the moving average, so we traded for some time above the moving average. Here we touched the moving average, we bounced, here it acted as a support, but look at what happened when we broke through the moving average. We closed below the moving average very comfortably, then we pushed lower, and then we created actually new low. So here, as long as we are below 100 moving average, we are actually in a bearish trend if you're judging MA as an indicator. So in a downtrend, a moving average acts as a resistance in the context of a ceiling. So the price hits it and then starts to drop again, like you can see here. So here we are below, it's a downtrend, we are below the moving average, we hit the moving average, it's as a resistance. Traders are looking to sell against this moving average, and we have a new low. We go above it, we trade above it, but you can see where we closed. We closed at the moving average, even though we pushed what it's more than 10 pips we pushed above the moving average. We could not close. In the case that we closed here at the high, in that case we would have probably pushed higher, but since we failed to close there, then we pushed again, create a new low. So here again we push, we touch the moving average, we go down, we push, touch the moving average, and we go down. So as you can see here, you obviously don't trade this because you don't know if it's going to break. Once it breaks, it closes at the down. Now you're waiting for a retest. So this is the strategy that we're using in order to make some profits by using the moving average. So here we wait for a first retest. So our first trade will be here. So if you're just a scalper, then you will most probably, what you're going to do is you're going to sell here. You put your stop loss. I always advise 10 to 15 pips in order to protect yourself from these whips. So here you sell, and then you say, okay, where is my first support? As I said, only if you are just a scalper, what you're going to do is you're going to say, okay, here is my support, so I'm going to sell at 123.40. I'm going to collect my profits on 123, more or less as 15, so that's 25 pips, and I'm risking 10 pips. So you wait for another retest. Here you're going to sell at 123.25. you say, okay, now it depends on your risk management. Are you going to allow 5 pips, 10 pips, 15 pips? I always advise at least 10 to 15 pips in order to protect this. Even if you're stopped out, then you just lost, let's say, 10 to 15 pips. If you put your stop loss 15 pips, which you would put here, then you'll be still in game, and then you could still gain some money. For example, again, if you're just a scalper, you say, okay, what I'm looking at is actually, I'm just going to look at the price here, so I'm going to make 20 pips. So you have one, you have two, you have three times when the price, you see, VIPs are above the moving average, where the price goes above and then closes at the low, which is another indicator that the price is going down. And then you have 3 chances where you make money, even if you're a scalper. If you're a more intraday trader or a swing trader, then most probably you could have gained at least 50 pips in each and every of these occasions. Even here, if you decide to sell here and say, I'm going to trade it as long as it's below the moving average, even if you sell it here, then you will be most probably stopped out. You can see here, and then again, you lose 10 to 15 pips, but you already made, for example, in these 3 occasions, around 100 pips. So another chart, it's a pound to dollar chart, and this is a very good chart that I found. It has everything that I wanted to show you. So here you can see that we break below, we have here a gap, we break below, we trade below. You can see here we have a touch, we go down, here touch, but we managed to close above. So as soon as we close comfortably above the moving average, now we are in an uptrend, and we are looking to buy the price at the first retest. So here you buy it, look where it goes. So even if you just bought it here at, let's say, 131, let's say 35, and you wanted to see a repeat of this high, then we're talking about 50 pips on a 1 hour chart. So you close it here, then you go down, touch, you go up, down, touch. You can see here we went 6 pips, so your stop loss would not be activated. Again, you go up, down, up, and then here, this is what most probably will put you out of the game. This is what I wanted to show you. This is why it's not, everything is not so pink in trading. Is actually you close below the moving average. You can see here that you close below the moving average, but more importantly, actually the price goes 15 pips, so most probably your stop loss will be activated, will be out of the game, and then the price simply bursts higher and goes and creates a new high. But even if you're stopped out here, as I said, 1, 2, 3, 4, 5 opportunities for you to make money by using the simple moving average, either as a resistance or as a support. And as soon as you trade clearly above or below the moving average, you're looking for retests, put your stop loss 10 to 15 pips lower, and then look to take profit at the first support or resistance if you're a scalper or an intraday trader, and you look for more bigger and advanced profits if you're a swing trader.